Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be talking about Realty Income, and I'm going to be telling you guys why I still think it's trading at a cheap price. Now, I have not talked about any REITs on the channel for quite some time now, so if you guys are into this type of content, consider subscribing to the channel. I would really appreciate it. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now, as always, let's start by taking a look at my portfolio dashboard. So in total, I invested $48,671, and my current portfolio value is sitting at $58,771. Now, this week has been pretty good for my portfolio. My unrealized gains are now at $10,000. I think last week it was about $8,000 with a total return now of 20.75%. Now, as you guys may have noticed right here, I don't actually own Realty Income in my main portfolio that I show on the channel. I own it in my Roth IRA, which I do track the Roth IRA, but more personally, so I only show specific parts or specific holdings within my Roth IRA. Now, the main reason for that is that I want to take advantage of the tax benefits within the Roth IRA. Real estate investment trusts are actually taxed a little bit differently than regular holdings, which tend to pay qualified dividends, whereas REITs are actually unqualified dividends more often than not. Now, because of that, they tend to be taxed at a higher tax rate, and also REITs such as Realty Income, which we'll see a little bit later, have a higher dividend yield than a lot of my positions here. And as you guys can see right here, my portfolio yield is at 1.63%, so I clearly prefer it on the lower end. Now, it is nice sometimes to have higher dividend yielding stocks, and I do have Altria Group right here, which trades at a little bit under 8% dividend yield, and my yield on cost is actually closer to 10%. But in general, I like to keep my dividends on the lower end because of the tax implications. Also, my main focus currently is maximizing my potential total return, so it doesn't make sense to focus on dividend yield specifically, but I do prefer to buy companies that do pay a growing dividend over time. Now, in this video, we'll take a look at my personal position within Realty Income. I'll show you guys exactly how much I own, how many shares I own, how much I invest into the company, my total return so far. And we'll also take a look at the dividend history and how much I've been paid out in dividends since I purchased the stock. After that, we'll hop into their investor relations page in order to take a look at their most recent dividend payments and see how much they've grown since the start of the year. We'll finish off the video by taking a look at the company's performance and some of their financial metrics, and then I'll give you guys my answer on whether or not I'm buying more shares of Realty Income or if I think it's trading at a good price right now. So hopping into my holdings section of my Roth IRA spreadsheet, we can see right here my average price paid for Realty Income is at $52.32, and I'm really happy with that purchase price. Currently, shares are trading at $56.89, so it's not too big of an increase compared to what I paid for it, but I'm not in a hurry for this position to gain momentum just yet. In total, I purchased 53 shares, and with dividends being reinvested back into the company, I have 56.932 shares, and I invested $2,773, but the current value is at $3,238. This gives me an unrealized gain of $465, or a total return so far of 16.8%. Now, for this type of company and for the current economic environment, I'm actually pretty happy with that total return. I have gotten better total return on some of my other holdings like Agri Realty. And if you guys want to see a video covering Agri Realty, I'll pin it right up here. In terms of dividends, I actually have earned a pretty substantial amount, about $220 so far, and each stock pays me $322 per year or $183.32 per year across all the shares that I own. The current yield is under 6% at 5.66%. My yield on cost is actually over it because I bought it at a cheaper price and dividend has continued to increase over time, and I've also reinvested my dividends. Now, hopping into my order history tab, we can see all my dividends right here, and I've already filtered them out to show just Realty Income so we get an idea of how it has increased over time. So right here, you can see that I actually put it out of order. I believe I probably waited 2 months before adding this position into the portfolio, and I accidentally put the November dividend before the October dividend, but that doesn't change anything regardless. So my first dividend from Realty Income was $154. I reinvested it to get back 0.031 shares, and it was about $50 per share at the current price. Now, the dividend after that was at $4.36, and I'm not going to go through every single dividend, but you can see right here that they do pay monthly dividends, which is something I really like about the company, and over time it has increased pretty substantially. Now, the main reason that the dividend has increased so quickly in the first year or two of me holding is because I continue to add more money into this position. Now, if we fast forward to June of 2024, which is right here, you can see that I got paid $14.20, and I believe that's the last time I added any more shares into my position of Realty Income. If you guys do remember from the previous page, I invested over $2,700 in this position, which is a pretty substantial amount in my opinion, and the current value is even sitting at $3,200, so I'm not looking to buy any more shares too aggressively at this point. So from this point forward, the only reason the dividend increased was from 1, dividend increases that the company announced, and 2, from reinvesting in dividends and buying back more shares in the company using those dividends. So you can see here that from June to July, it increased by 10 cents, then by 7 cents, and you continued going down the line to see how it increased over time, and my most current dividend was $15.21. So assuming that I didn't forget that I added any more shares anywhere here in this time period, you can see that I went from $14.20 to $15.21 in less than a year, and that's just from reinvesting those dividends back into the company and those dividend increases that the company announced. Now over time, the dividends from this position will continue to compound and they'll snowball into much more significant amounts. I know a lot of people buy higher dividend yielding stocks in order to get the dividend and reinvest it into other positions, but I currently have no intentions to do that. I want to continue reinvesting it back into the companies that paid it out, especially for Realty Income, because I like the way it compounds. Based on the amount we saw earlier at about $180 that I'm going to be getting in dividend income, that's going to buy me about 3 shares of the company per year, assuming the price doesn't go up too quickly. So quickly hopping into their investor relations page, I just pulled up their dividend history, and you can do that yourself by just looking up Realty Income Investor Relations and then just moving into their dividend history section. So here you can actually find every dividend that they've ever paid out, and I believe since they IPO'd, they actually have been paying out monthly dividends that whole time, and a lot of other realty or real estate investment trusts, I should say, have copied this business model, including industrial ones like Stag and also their competitors like ADC, Agri Realty Corporation. Now, normally in these videos, I would go into much deeper detail on their investor relations page, showing you guys their most recent presentation and some of their tenants, but I want to make this video a little bit more brief. I've actually covered that in some previous videos and not too much has changed since then. If you guys want a more detailed overview of the company, I'm going to pin a video right here, but I also suggest you just check out the channel and see some of my other uploads on Realty Income, and also just leave any questions in the comments down below and I'll be more than happy to get to them. In general, they have pretty strong and well-diversified tenants, including ones like 7-Eleven, Dollar General, and the Dollar Tree Group. One of their tenants that I don't like as much is Walgreens. Walgreens has been struggling, but they tend to own pretty prime locations, so I assume that those Walgreens locations will actually do better than some of the other ones. All in all, they are diversified pretty well and they have very high occupancy ratings, so they should be pretty good going forward, even if Walgreens does shut down some of the stores. So as you can see right here, the company does try to do more than 1 dividend increase per year, and I believe that they usually aim for about 4 dividend increases per year. And this year alone, you can already see that they have done 2 separate dividend increases. From January to February, they increased it by 0.004 cents. And then from February to March, they increased it one more time by an even smaller amount. Now, although these amounts are small, they do compound pretty nicely over time, and I do hope that we'll start seeing some bigger dividend increases from them in the future once interest rates do begin to come down. Now, if we just take these 2 numbers here, the starting value for January in 2025 and the most recent dividend, we can see that the company has increased their dividends so far this year by 1.7%. Now, I believe last year that they did increase it by less than 3% total, but hopefully this year we'll see a little bit better increase. So next, let's take a look at some of their financial metrics. So they have had a pretty rocky 10 years. COVID really set them back pretty significantly. The company used to trade at some pretty lofty valuations, and since then it's had a pretty hard reset. Now, these are not the best financial metrics to look at for real estate investment trusts. These are more focused on regular stocks. That's why I built it the way it is. But we'll take a look on Seeking Alpha later for more specific information. But in general, we can see the revenue per share has continued to increase, and so has the earnings per share, but at a much slower and less consistent pace. Now, free cash flow per share has been growing pretty strongly, and the same can be seen here for the general free cash flow compared to stock-based compensation, which is basically non-existent. Now, this doesn't include all the years, but you can see dividends continue to increase every year with multiple increases per year. But something that is a little bit unfortunate is that the shares outstanding have increased pretty significantly. Now, this is a pretty common tactic used by a lot of real estate investment trusts. Instead of taking out loans, especially in these higher interest rate environments, they may opt to sell shares in order to complete acquisitions. Now, in this case, I believe this is exactly what Realty Income has been doing in order to fund some of the more recent acquisitions in order to avoid paying those higher interest rates on newer loans. Now, in general, shares outstanding going up is not great, but the more important metric to look at is AFFO per share, because if their adjusted funds from operation continue to go up, even if they're diluting shareholders, then that's not bad. Now, if you guys have made it this far into the video and are enjoying it, you should leave a like on the video. It helps me out a ton. Now, hopping into Seeking Alpha, we can take a look at some of the other financial metrics for the company, some of the more relevant ones, but we can also see a better picture of their performance in terms of stock price. So year to date, the company is up 6.52%. In the past year, it's up 5.74%. In the past 5 years, it's up 10.88%. And in the past 10 years, it's up 21.6%. Now, what you guys may have noticed is that this is underperforming the S&P 500 by a decent amount, and I would agree with you. One thing to consider is that we do have to take the dividend yield into account. 5.64% per year goes into their performance basically if you're reinvesting those dividends back into the company. But even then, it's actually underperforming the market. Now, the main reason for that is the higher interest rates that we have seen. It's made the company a little bit less profitable than it used to in the past, and their expenses have gone up pretty significantly. It is also causing slower growth in the company as it can't acquire as many properties at these higher interest rates because it can only dilute shareholders so much at one time. Now, if you want quick gains, this might not be the company for you, but if you are willing to write it out, that's the reason I purchased the stock. And I think that once interest rates begin to come down, and once they come down significantly, then this company will see a pretty big correction in its stock price. Now, long term, it's not going to perform like a growth stock, and I'm well aware of that, but I think it'll fit a pretty nice niche in my portfolio and will add some much needed diversification with a bit of upside potential if interest rates come down in the future. Now, in terms of their 52-week range, the low was 50.71 and the high was 64.88. It's currently sitting at 56.89. Honestly, it's a pretty solid price. Now, I don't think we're going to be seeing 50.71 again anytime soon unless we have a big stock market correction or a recession. So if it does happen, we might see some cheaper prices. But if not, $56, maybe $54 might be the lowest we'll see. Now, the price to FFO ratio is 13.32, but the only way to really value this is to compare it to other REITs. So the main thing I wanted to show you guys on Seeking Alpha is their adjusted funds from operation per share, and unfortunately it doesn't have every year listed here, but the main thing we can see is that it has been trending upwards over time, even with the stock dilution. That's important because as a shareholder, if the company is diluting shareholders, then you have to make sure that you're getting more value out of it in return. And in this case, since the AFFO per share continues to trend upwards, I would say that you are getting more value than you are losing from the dilution. Now, in terms of my thoughts on Realty Income, I do have a pretty sizable position myself, and if I didn't have such a large position, I would probably be adding more at these prices. Now, because my position is already worth about $3,200 within my Roth IRA, I'm not looking to add any more shares in the position currently, and I'd probably be looking to add only if it dropped below $50 per share. Now, if I didn't have a position in the company at all, I would probably be adding at these prices. I do think that's around where I started adding into Realty Income myself, and as it dipped down, I continued averaging down my price. Now, for those of you that are hesitant, it might be worth waiting a little bit longer and seeing if we have a correction in the market or a recession that might bring an even steeper discount to the stock price. Another thing to consider is that compared to their competition like ADC, which is Agri Realty Corporation, they're actually trading at a bit of a discount. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at Realty Income, seeing my own personal position in it, some of the financial metrics, and hearing my thoughts on whether I think it's trading at a fair price and if I'm buying more shares right now. If you did make it this far into the video, comment down below whether or not you have a position in Realty Income and if you're going to be adding more into your position, or if you're going to be starting a completely new position in the company if you don't already own any shares. If you haven't yet watched last week's video where I did a stock spotlight on United Health, check it out right here. And if you guys do want to see which 5 discounted stocks I've been buying up, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.